Welcome to Preserving Your Wealth with Mike McCormick, where we talk about smart ways to invest and preserve your money. Mike is a registered investment advisor with McCormick Financial Advisors in Bozeman, Montana. As an independent fiduciary, Mike does not receive commissions from any of the products or investments mentioned on this program. Consult a professional before making any investment decision. You can find old shows archived at McCormickFinancialadvisors.com. Learn, participate, interact.
Mike McCormick in the house. Shaman Taubman, half man, half amazing on the line. Tom Eagleoff, your morning mayor. Welcome to the KMMS Morning Soapbox. Glad to have you, Michael, as normal, as usual.
It's wonderful to be here. Merry after day Christmas.
Yeah.
Merry Christmas. Happy New Year, Mikey.
That's right. We're on to Happy New Year now.
Yeah.
Four more trading days in this year, 2019. Historic gains.
I know. Pretty amazing, isn't it? To the year we've come through. With
I can't believe it. With all we've done,
with all the impeachment, with the tariffs, with everything going on, and
the big one for me, Tom, was the inverted yield curve, and I know that really gets people fired up to hear that. But
that's where the 5 year is more than the 10-year, and whatever.
It relates to being incentivized to spend money now.
Yeah.
It was upside down. It's an economic indicator, but it's a big one. It's one that has a really strong correlation to forecasting bad times. And we brushed it off, and everything seems to be, well, it's hard to find anything wrong with our economy other than it's expensive. Yeah, it's expensive.
It's pricey out there. There's no question. But
if you're in Switzerland, everything's really expensive, and everybody seems to be okay with it, right?
Yeah,
seems to be working.
You're getting a bunch of free stuff for that you're paying for. So,
right. One way or another.
Well, I don't have any money, but hey, I got health care and I got college and whatever. So I guess works okay.
And we got some new snow falling outside right now.
Do we?
Yeah.
All right. Snow out there.
It's going to be a beautiful day. Everybody's got, hopefully people have the rest of the week off. Obviously, there's some people that need to go to work, but maybe it'll be a little relaxed pace and happy spirits out there today.
Yeah. So you got your coffee here, don't you?
I do.
Yeah. We were talking about coffee earlier because this guy invented the percolator back in the 1800s, and you're absolutely right, Tom, from our text line. I'm old school when it comes to my coffee. I want some Java that will open my eyes in the morning. Too many people, including most millennials, drink these designer coffees so heavily flavored that they are unrecognizable as real coffee. I want coffee with the highest possible octane rating. That's from Steve Owen.
Mm-hmm.
And I would go along with that as well. Yeah, I like, as I said, I'm tough. I drink it black. And
I'm a creamer guy. I can do black.
Yeah.
I can do black.
Yeah.
One thing that I would love for them to invent, and I was looking for this for Christmas too, is a coffee pot that can pour without dripping.
Oh.
And I don't know if I'm the only one out there that does this, but, we have the latest technology in coffee.
You'd think so.
And transferring the coffee from the pot into the cup should be something I'm athletically capable of without spilling a drop.
Yeah.
It's not possible.
I don't know. Shane, you have that problem in Canada?
That's just an American problem?
Has Tim Horton solved that problem?
Yeah, I have a pretty stable hand. I'm not much of a dripper, no.
I guess I got the shakes.
I don't know, man. It's well, we digress. We should be talking.
Well, it was nice that Christmas Eve we did not have a huge pullback when nobody was really at work and having the computers do the trading for us. That was unsettling.
Yeah,
that was not a plus in my stocking last year. This year, but
yeah, we didn't have the Santa surprise that we got last year.
Well, because we were on guard for it, maybe. I mean, it really is one of these, when you least expect it things. And that's a good rule in business. I've ran my own companies in other industries, too, and I've got a few friends, and we always would say, hey, how's business going? Oh, it's going great. And we'd say, well, that means that you're not paying attention because something's always
going on.
Something's, that's the nature of the job.
I was surprised a lot of people didn't take profit at the end of the year because the market was up so much over the year. This would be an ideal time to say, what's a weak performer here? Let's cash out of that one and maybe move some money over here or put it in bonds or, do something with it other than just leave it where it was.
And that's a great question, Tom. And the way that I respond to that is that the individuals, the people that are listening that invest for retirement, we don't move the market typically. Hopefully we don't. And so when you're looking at who moves the market, it's big institutional money managers. It's money managers that are either managing mutual funds, hedge funds, or running portfolios for very large institutions or very wealthy people. They can move the market. And because this year only 20% of stocks beat the S&P, beat the index, so many fund managers underperformed. Anybody, pretty much, I mean, it's always been tough, but this year is maybe the nail in the coffin for active management. So anybody that's out there that's been trying to home game it, trying to Jim Cramer it, trying to say, hey, my fund is going to outperform, it has really stiff odds against them. If 80% of the stocks out there are going to be pulling them down, they have to be very good. And so in most cases, these fund managers can't afford to sell and miss out on something. So they need to be carrying full load of risk into year end, trying to get back close to the index, because if they're not, well, they're going to lose money next year, meaning that they're going to have outflows. Investors are going to be pulling money from these managers. They're paid on a percentage of assets, similar to most people in this industry. And so their incentive is to try and bring their incentive is to bring the performance up.
Right.
But flip this with somebody that was running a fund that maybe was outperforming. If you were outperforming the S&P, if it was one of those years where it was easy to make an easy pick and you did well, you would then be saying, okay, well, I want to sell, I want to reduce risk and avoid any potential catastrophes and sort of just coast into the finish line because I got such a lead right now. Whereas the opposite's the truth, is that these managers right now are putting their last sprint in trying to catch something, and the only way that they can do that is by owning risky things and carrying it through. So that's one of the arguments that I've heard, is that we're not going to see a sell-off. Now, does that mean that we're not going to see one next year? I think that's probably, we have had many Januaries I've sat here and we've watched it tank at the beginning. It might be that way. I mean, we've talked about crystal balls and so on, but my crystal ball says that we're at this point looking like a Trump win, and that will create a rally in the stock market. My belief is that we are going to have some pullbacks and simmer down of the stock market leading up to that, so that we can have a good pull, so that we can have another good gain and not really get too far over our skis, is the poor expression out there. So there'll be rough times next year for sure. We don't know when, we don't know why, probably election related, probably news flow related, maybe tariff related, maybe just a fundamental, everybody decided the stock market was expensive. Everybody decided it was time to sell. We're not going to play that game as long-term investors. We're going to take the ride through that. So next year, it's so wonderful to be sitting on top of a year like that. And then when we look to next year, looking for the hidden bullets, it's hard to find them. I'm not hearing a lot of good stories about, a lot of conviction as to what's going to happen.
Yeah. What do you think, Shane?
Well, it's always outside circumstances in a case where you find yourself in a market like this.
Mm-hmm.
And as Mike has rightfully pointed out, that the landscape is terrific and the valuations are high. So it makes it difficult to move into the market at this time. But I go with the old Joe Kennedy, I made a fortune selling on the way up. I think you should always be in cash. If you've got stocks that you've made a significant gain on, I'm not saying you sell all of them, but I would be slowly putting myself into cash, because, the market is a boom bust. It just, no matter, you can argue it all you want all day long and you can't necessarily determine when it's going to happen, but at some point it will be. And as I said at the outset, it's always caused by something that you didn't see coming,
yes,
right? Like that,
right.
Yeah.
Wonder if that dope in North Korea fires off a nuclear weapon at Japan.
Yeah.
Hadn't thought of that one. You're right.
Yeah.
You're right.
Yeah.
The world markets would go, what? What did he just do?
Yeah.
And wonder if he fired one off at Guam.
Yeah. No, there's all kinds of things that you have to be. Mm-hmm.
That's a harsh example because I did. Look, the world's not in as good a place as everyone thinks it is. Chile's still riding on fire. France is still demonstrating. There's countries that are out there.
Hong Kong,
Hong Kong, Mexico's a failing state. So, there's a lot of stuff that could happen. Yeah.
Yeah. Well, and also too, are they going to sign this USMCA? What about Brexit? I don't see personally, and this is, I'm not here to advise anybody to do anything, but what I don't see much of a change in the first quarter because we got the elections in there. I think a lot of people are going to be fixated on those things. I don't know that it's going to be a whole lot of economic news unless, as Shane says, somebody fires rockets off somewhere. But I think I think from January to March, people are going to be fixated on this presidential election, and I don't think it's going to affect the markets all that much.
And the other thing with China, with China is either Trump is brilliant and broke it into two pieces because of the way to negotiate it, or he told them we're going to wait till the next election on the tough stuff.
Yeah.
So he said, well, let's get done what we can agree to. We don't know yet really what it is. We'll find out, I think, sometime here in the next 60 days. But that could change everything, too.
Well, apparently there's a big soybean buy contemplated that, will help the commodities market somewhat.
Yeah, well, they've been talking about that for how long, Mike? A year?
Yeah, they have. Well, they brought it up more recently, so whether it will or whether it won't, I again, as I say, I'm not trying to tell anybody.
Well, let me walk through a little, real life scenario.
Go through it. Yeah.
With if you're an investor.
Let's take a break before we do that.
Good.
I'm sorry.
I need my coffee. I need to take a coffee break here.
Yeah, Shane needs a break too. He's sitting there in his jammies.
Old man jammies. I got them from my family.
I was going to say you look like you're wrapped up like Scrooge.
I am. Look. I got my hanky in my pocket and my jammies.
I tell you,
Good thing it's a radio show.
He's not just a pretty face, I'll tell you. Right.
Just another voice.
All right. We'll be right back with more with Mike McCormick following these important words. So stay tuned. It'll be a short break. It's only 1 minute, or 30 seconds, actually. So hang on. All right, welcome back. Excited to be here 19 minutes after the hour. It's Thursday, December 26th. Mike McCormick in the house, and well, we're kind of contemplating, I guess, what's going to happen in the next few months.
Our naval lint.
We always do this at the end of the year.
Well, of course, scratch our head.
We never know what's going to happen. We guess, and we.
And between the three of us, nobody's right.
Nobody's right. Yeah.
Well, here's a real life situation that I worked with a client over is they had Apple, and they still own Apple. And they have tremendous gains in it. They bought it back in the late 90s and have obviously it's done it great. And this isn't a taxable account. This is not an IRA account. So this would be just like taking extra cash you have, opening up an account, investing in something, and it grows. Well, you have a capital gains issue. The capital gain is the price that you would sell it for today versus the price that you purchased it for. And since it's over a year, you get long-term capital gains treatment. This is tax 101. That's good. You want long-term. Long-term capital gains is lower than if it was under a year, you'd be paying ordinary income taxes on it. Ordinary income tax rates, this is a California resident, about 30%. Capital gains, they start at 30% and then they go up. Capital gains rates, depending if you're in retirement and what your income level is, could be as low as 20%. So, okay, we're looking at 20% plus California state taxes and so on. Anyway, the gist is this. If you have a large position and you're looking at taking money off the table, you have to pay taxes. Okay, Mr. Investor, that's the reality. You made money, pay your pound of flesh, no big deal. Well, this investor is elderly, over 80 years old. This investor has no need for cash. This investor does not need this money. They're unlikely to be spending this money. They're just trying to do a prudent job of rebalancing their portfolio for future generations, really, in this regard. And so how much of that should involve taking a tax hit now versus inevitably this client, unfortunately, will pass, and there will be a full step up in basis, and the heirs wouldn't have to pay taxes on any of this Apple stock. So now I have to weigh the decision about, is Apple something that we should be diversifying away for now to avoid a potential pullback that might damage the portfolio more than paying taxes on it and just plugging your nose and hanging on to Apple, right? Well, Apple has done quite well. It's a good holding. So I told the client, I said,
$1 billion company.
The question's not should we diversify? Yes, that's a good idea. The question is, what do we do with that cash? How do we reinvest that cash in a way that would reward you as well as if we would have just stayed with Apple, even through whatever cycle. And so the solution we came up with was, as always, it's take a portion, at most a third. We decided on a sixth of the portfolio. It was a big position, but the rule of thirds is always good. If you have a good idea, just do a little bit of it, and then you can always do more later. And so taking the money, selling the position, paying capital gains now, and the capital gains bill is going to be significant, so we need to take a portion of the proceeds and allocate it to the tax. And then what do you do with the money going back in? Here's what I did. I went into a technology index. I said, I think Apple's a fine holding. The reason why we're diversifying is not because we are suspicious that Apple's got a problem. We're just recognizing that this is pruning the bush. This is what you do. This is mulching. This is aerating your lawn, whatever you want to call it. And so what we did is by buying an index fund, we're not paying an active manager a fee to try and guess which stock's doing better. We're using a market capitalization approach. The fund has a basket of technology stocks. The largest holding is the largest technology company, now Microsoft. Apple's right behind them. And so we have a diversified portfolio of, in a concentrated way, about 20 positions. And what's really neat about this exchange-traded fund model that I think investors need to understand is if you grow old with one of these funds, you will also encounter a capital gains issue. However, we won't be looking at it we will not be looking at it as a single risk position like this client has in Apple. We'll say, well, we have a high taxable gain in this fund that's spread out amongst 20 to 200 companies. And guess what? This fund in its own rebalances all by itself. When Microsoft surpassed Apple, this fund adjusted inside of it, and there was limited tax consequences for the investor. So these funds can be wonderful ways to not have to have these capital gain reallocation problems at the end of the year. And it's one of the reasons why they're gaining so much inflows these days. Another suggestion is that this is not what's referred to as a wash sale as well. There's a caveat in the investment world where you can't sell a position and buy it right back and shed the tax liability that may have been avoided by doing that. So there's a lot of different tools out there, but it's not as simple as saying, hey, you got to sell your winners and buy your losers right now. This is what we're supposed to do. Not when you're looking at big tax consequences and you're looking at an investor like a lot of people. You're saving this money. Yeah, it's for a rainy day, but you hope you don't need it. Might be there for a long time. Why do we need to change course right now?
Yeah. No, I agree. We're in a comfortable position right now with the market and everything the way it's going.
We are.
But there's still that feeling of, is this 2009 coming again, or
muscle memories?
2008.
Muscle memories not that far away.
I'm sitting here going, what do I do? What do I do?
Well, I do have concern for first quarter, Tom. I do, because I think that's when a lot of people are going to say, okay, this is not the perpetual money making machine.
Well, we always think anytime the market's doing well, we always tend to think it's overvalued. Yeah. And in some cases it is.
Yeah.
So, many stocks are overvalued. I think you'd agree with that.
For sure.
Not all, but
the technical term we use is expanding multiples.
Right. Yeah.
Which is hysterical. Listening to these commentators talk about. If the company doesn't make more money and the stock price goes up, it's because it's getting more expensive. Yeah.
Their PE is 50, but that's probably normal for them. Right. So. Should we get out of here or what?
Right.
Now, as mentioned, last Christmas we saw this big sell-off.
Oh yeah.
That everybody bailed out, and I don't know whether they felt the market we were going into a depression or a recession or whatever, and they decided to cash. As
I think
Shane said, put money in cash.
Right.
The other people came along and said, well, everything's on sale, so let's buy. And, coming into January, we were back sort of.
It snapped back pretty quickly. And if you look at things in a reasonable time spectrum, that seems to be how it goes. Now, it doesn't mean it's comfortable. It doesn't mean it's comfortable at all. And I do think that, if Santa gave you a bunch of cash under the Christmas tree, be slow to put that at risk right now. I think it's a great time for people. Really, of course, I'm a financial planner. Of course, it's time to take inventory of where you are. Another year older, a new one just begun. What do you want to accomplish? What do you have on the plate? Paying down debt, it's a wonderful time of the year.
That's always a good thing to do.
Right.
Yeah.
But we will talk a little bit about setting goals and setting up savings mechanics maybe after our next break. Right now, what I'm listening to out there is the commentators, is talking about forecasting. And the big moves that created a great environment for this year are unlikely to be undone, meaning the Fed interest rates probably on hold, probably in the back seat of it all. In terms of fiscal stimulus, we still have a little bit we can do. We passed a budget that's going to provide some uplift for some sectors of the economy. And in terms of trade negotiations, I think that we're getting comfortable with this there back. We're getting comfortable with the news flow that, it's not going to be a straight line. It's not going to be an orderly chess match. It's going to be more of a boxing match, you might say.
Yeah.
And so there's going to be some tussle with it. And I think that we're getting comfortable with this idea for the elections that there's going to be this incredible news flow of shocking headlines that's really only targeted towards, I don't know, Shane, how many are the undecided in the middle?
32%
of the people. So that means it's, chances are it's not targeted towards you. It'll get a reaction out of you, but it's not who you're trying to reach out there. 32% undecided. Is that historically a large number, Shane, or are we looking on?
No,
it's pretty normal.
It's normal. Yeah.
Okay.
Yeah. From our text line, 478-8298, the Dow Jones is at record highs. Interest rates, cost of goods and services relative to income are disproportionately high as a factor of disposable income. Unemployment is near record lows. I say all this to preface what is being said by many financial gurus. They are making comparisons now to what happened prior to the Depression, the 2008 dot-com surge. Well, it's 1998, actually. And even the Nike index years back, but they're forecasting record-breaking melt up. Then the biggest, most prolonged bear market we've ever seen. Hype? Please tell me what you think. And we'll have to hold that until after we come back.
I will.
But that's a mouthful of.
That's a mouthful. And, there's also a new significant IRA change that went through in this last spending bill that we should probably talk about, too.
All right. We'll be back with Mike McCormick right after this. Stay tuned. 25 minutes before the top of the hour. It's Thursday, December 26, 2019. Mike McCormick, McCormick Financial Advisors, is in the house. And Shima Taubin, half man, half amazing on the line. And Tommy Goloff, your morning mayor. And a question from our text line, 478-8298. They're forecasting a record-breaking melt up. Then the biggest, is it going to go up to 30,000 and then it tanks? Is what they're thinking. So what do you think? Are we going to hit 30 in the next 6 months, and then it'll suddenly tank into the a prolonged downturn because of the whatever happens with the election, or who knows what?
My forecast for a pullback in the first quarter next year, and then a gain through the election. That's really my wishful thinking, I got to tell you. Everybody's biased, right? Here's what I think is going to happen because this is kind of what I want to have happen.
Right.
You got to acknowledge that in all of ourselves. The comment about it melting up, that's certainly what's been happening, right? It's certainly, complacency. This is the most hated bull market ever because there's still people that haven't gotten back in from 2008. There's people that at this point they're not going to. And so there's a lot of like distrust of this gains that we've been having. It's just because the Fed making easy money, or it's just because it just doesn't matter what it's just because. It's been tremendous, and I hope you've been a part of it. So to the commoners' assessment that if we have a melt up, and then we'll be in big trouble. It's not too far off, right? We're not going to go. This thing does not go in a straight line, and that's what's alarming about it is that it has been going in a straight line this year. And so we're gonna find a way to not keep going in a straight line. That's either going to come from short-term sort of jiggity-joggity scary stuff, or it's going to come from really big moves. And if we're complacent and we melt up to a valuation, we're already stretched. We're at about a 25 PE multiple right now. If you look over the course of recent history, 3 decades, That's sort of the hot lava zone right there, where there's going to be something that needs to happen. We either have, the preference is that corporate earnings go up and everything all of a sudden seems reasonably priced. The other side is that people pull money out and valuations go down. So time will tell. Be prepared for either one. Prolonged bear market, that idea, I don't see that. I don't see that in the near future. I see that as sort of you've heard my quips about low population growth, low productivity growth, big macro forces that'll take a decade to sort of play through, but have a lot of uncertainty associated with them too.
Let's take a phone call. 522-TALK is the number. Caller, you're on the Morning Soapbox with Tom and Shane and Mike McCormick. What's going on?
Well, Daniel R. Peterson, being the contrarian, heard that China was going to buy these huge amounts of American soybeans. And I, for one, said, I don't even know if that's good news. America's crop is 85-90% genetically modified, taking the reins from Mother Nature. As you might know, when America was playing around with tweaking the genes of the wheat crop, some of the biggest buyers in Europe, South Korea, Japan said, we're not going to buy GMO wheat. And the experiment stopped dead. In a letter I wrote to Barron's, I questioned how much focus there was on only making money on a market, not whether the investment was helpful or responsible. How much focus do you think big investors have on the quality of the company rather than the quantity of money to be made?
Well,
that's a good question. Thank you, Daniel.
Yeah. Shane, I'll let you jump on that if you like.
No, go ahead, Mike.
I'm going to defer to you.
Oh, no, please, no. It's your time. You go ahead, Mike.
Quality over quantity, is that where we're going?
Well, I think the thing you got to keep in mind with any company is that you have to, just like you're a fiduciary for your clients, your company is a fiduciary too. It has to react in the way that's most positive for its stockholders. So whether quantity is a good thing or whether quality is a good thing, that's the decision that has to be made. Now, I don't know. I have heard of the genetically modified wheat. I haven't really heard of genetically modified soybeans. There probably are.
Sure.
Sure. But I don't think China has put any restrictions on the soybeans, whether they're GMO or whether they're
they haven't
generic or whatever. Not that I've heard anywhere.
And from the agricultural business, and I'm not a rancher, I'm not a farmer. But
okay, I'll give you an analogy.
Thank you.
All right. Everybody on this conversation, including Daniel, my question to both of you is, property prices in Bozeman overvalued or overpriced?
Wow. Semantics happening this early in the morning.
Yeah.
Overvalued or overpriced?
But there's a difference. There's a serious difference.
Yeah. Well, there is. Yeah.
Okay. So you apply that to any company that Daniel's representing, and you have to look at it there's three aspects, actually. Is it overpriced or overvalued, or is it available? Because if it's not available, that affects the pricing and the value. So in the stock market today, like in real estate in Bozeman, there isn't any stock. The whole world has so many wealthy people. They bought up the stock, and the price that's driving it is not its intrinsic value. And the intrinsic value is going up in price because there's a lack of stock. So like Mike and I are looking at this and going, wow, we're looking at companies that have 18, 19, 20, over 20, times earnings. And we'll both tell you for the last 70 years, you didn't buy anything over 16, maybe 8.
Right.
But you're waiting patiently for a correction. And that's why I say, and I don't disagree with Mike, cause and effect is what's going to deal with the market, because something will cause and the effect's going to be big.
Yeah. So,
and that's why you hedge.
Yeah.
That's why a farmer doesn't only grow genetically
That's
modified
exactly
soybean oil. I mean, soybeans. That's why investors don't only invest in one thing. That's why even if you open up a shop that's doing services, you don't only rebalance tires. You also
or
sell tires.
Or why keep stock out there if you're not going to expand or do something else? Buy your stock back because it's a liability if it's sitting out there.
Into the price versus value contrast that Shane was alluding.
That's right. It's just like '08. It took 5 to 8 years for the FCC and everybody to investigate. And last Christmas was a forced wash, meaning same situation. Everyone was away because of the day of the week that New Year's and Christmas fell on, like this year, Wednesday. So, somebody got really wise and thought they'd be real cute. And they forced a drop in the market to activate stop losses and puts that people had on stocks. And that's what caused it to drop fast and then recycle back, because that's just a natural cycle in the market. So it was some hedge fund guy out there or some bank that, let's go make some real quick money. And that's what they did. And, but like I said, the SEC's investigating it, but you won't find out for another 3 to 5 years.
Oh gosh, right?
Mm-hmm. Yeah. So that's the issue. Yeah. All right, we've got to take another short break. We'll be right back right after these important words. Stay tuned. I guess it's not Monday, is it, Shane? It seems like Monday.
It seems like Monday.
Let's call it Monday for sure.
I just pull out the Monday morning theme like it's Monday morning. I don't know.
It's a real short week. I'll tell you that.
I just had 2 days off from our website. Dude, it's like Thursday.
Happy holidays.
Amen. I don't know. Like I say, you come
too
back.
Much nog in your eggnog last night, huh?
Come back. I got to be retrained. But our stream doesn't seem to be working either. So we had to try to get it going earlier. I'll see if I can try to do something with it here at the top of the hour. But right now, not much happening on the stream. So, are you getting anything, Shane, in the stream?
No, it came in and it left again.
Okay. Yeah. I don't know what the problem with it is over there, but got to do something. So I don't know. Anyway,
I just love hearing that soft, silky voice here. So
I know.
Even turning the brakes, I listen.
I know. Yeah, it's pretty. I don't know what it is.
No, I don't know what it is either. Okay, let me save things. We've got changes for IRA rules. They just came through. They got slipped in with our recent budget act. It's called, what are they calling this one? The Secure Act. This is the Retirement Secure Act is the term they're using. Two basic provisions. Instead of having to begin your required minimum distributions at age 70 and a half, it's been pushed to age 72. So IRAs are money that you put away pre-tax. You said, I'll pay tax on that later when I take it out. IRS used to make you take it out at 70 and one half, saying, hey, it's time for us to get paid here. You've had enough of a holiday. Now they're pushing that back a year and a half to 72. Small impact to individual person, maybe, but on the big net, that's a big win for retirees. Everybody's winning longer. Winning and living longer.
Well, 2 more years of interest and everything on your Social Security. So
again, you don't have to take it all out when you take the RMDs out. This is required minimum distributions.
You'll have more to take out longer.
Right. You get to leave that in for another year and a half before you start taking it out.
Is it 4% you can take out?
You know where I tell people to think about it is it's about 1/30th of the balance, and that's because at 70 they say, well, you might live to 100, and so it's about 1/30th. And it's a moving target based upon balance at the beginning of the year, age date. There's a calculation that every custodian will do for you. You can find it online. Your CPA will help you with it too. The other part about this Secure Act is that the stretch IRA is going away. The stretch IRA is going away. Mm-hmm. Now, what the heck? Okay. Yeah. What this is that when you have an IRA, you have a beneficiary on it. Every IRA on the planet cannot be opened without a beneficiary. It's pretty neat. And so you have a built-in estate planning tool right there that's available to everybody. This is true with a 401k or a simple or all the other alphabet soup of retirement plans. you get to designate who gets your assets should you pass. You get to designate a primary heir. And should that primary heir also be passed when you go, there's contingent heirs. And so it's typically your spouse and then your kids. But then as you get older, you can do more things with that simple designation. It trumps wills. It trumps, to use the term, it trumps trust as well. So it can be very powerful. Well, when that heir inherits your IRA, it is then called a beneficiary IRA. These accounts are standalone accounts. They cannot have money added to them. They cannot be combined with anything else, unless in the weird circumstance there was another one that came from the same donor. So this is an account that just sits there. The Eddie Murphy expression is it's like luggage. It just hangs out.
Yeah.
Now, you get to you used to be able to take money out over your lifetime with a blended average of the previous donor's lifetime. Really long time. You can stretch these tax-deferred balances, allow them to continue to grow. It became a really popular way to increase the length of wealth that happened in your family. Now, the reason why this is being changed is because the economy likes the velocity of money. We don't like money just being stuck in the corners of the economy. We don't like it being stuck in people's pockets. We don't like having it stuck in people's portfolios. We want to have, like inflation, we want to have a reason why people should be getting that money out sooner. Mm-hmm. Stretch IRA original rule was to go with a 5-year requirement. It ended up at a 10-year requirement that within 10 years, the beneficiary must pay the taxes on all the money that's in there. It must be distributed according to the tax rates of the heir, as opposed to potentially over their lifetime.
Right.
So if the heir was a grandchild, that could potentially have stretched it over 2 lifetimes. If balance is left over, can even go again to another heir. So it's something where, yes, it's a ploy to boost incomes in the tax coffers, and it makes sense. First of all, as I always say with the estate tax debate, if you can't tax dead people, who the heck can you tax, right? So we found another way to tax dead people.
They vote.
Dead people vote?
Sure.
Yeah.
In Chicago. Why not?
Different. Okay, I'll let you guys tackle that one when I go. So should you care? Should we care? I had this conversation with a client the other day. You shouldn't be planning around that level of portfolio longevity without A, having a trust in place, or B, having a more sophisticated planning strategy. You can still change the beneficiaries to these accounts at any time.
Yeah.
And so now, some of this scuttlebutt is, okay, well, now maybe you should be looking at designating a trust as your beneficiary of your retirement accounts. I really caution you not to do that without consulting experts, which would not be financial advisors. Let me be first on that. There's important tax and legal ramifications that happen when a trust is the beneficiary of a retirement account. I've got a few. They're a hassle. They typically don't, in my limited experience, again, don't trust a financial planner. They don't always have the outcome that the people were hoping for. So, yes, this is a ploy to change retirement strategy that will end up boosting the coffers of the IRS, of the government. However, for the people that are living, the IRA is still a great tool. It still works. It's still there to help you save. It's still there to help you be encouraged to save. And so if I had one wish for everybody out there in the 2020 year, I guess it would be automate your savings. Automate it. It's not happening because it's not automatic. And so there's a lot of great online tools out there for you to make this happen. However, it makes sense for you. And I wish everybody continued prosperity. These are the good days. And I realize that individually people are out there having a hard time sometimes, but hopefully everybody can pick their head up and say, you know what? This is a good life right now. This is a good place to be. The sun's shining or the snow's falling, whatever makes you happy. And I'm not hungry and I'm caring for my loved ones. So, that's the sort of Christmas wish I have for you out there is don't stress about these things. We're here to try and help you make sense of them, make some good planning decisions. But the news should not control your emotions any more than the weather should control your emotions because you can't control either one.
Yeah. I was going to say, it's a crapshoot at best.
It is a crap.
Well, I don't know about that. You got to check on Tom's weather reports.
Well, that's true. Yeah. Yeah. Don't hold my feet to the fire for those. That's for sure. So, Let's see if there's anything going on around the world here that we ought to talk about. Let's see. Well, China, Japan, South Korea agree to push for a North Korea dialogue, and Queen Elizabeth, of all people, acknowledges 2019 was a bumpy year. So I don't know. I guess it was a bumpy year because of the Blixus deal, probably not because of.
Was that Brexit pronounced as Blixith?
Yeah, that one. Yeah, Brexit.
Blixith was our own local Brexit that happened about a decade ago.
Yeah.
But yes, the Brexit deal. We're all wary of those stories, right? It's just.
Well, we're wary of stories that go on forever,
Yeah.
And,
like Game of Thrones.
Like the Russian, like Game of Thrones, or the Russian deal, went on forever and ever and with no end in sight.
Well, and as I've said before, on one side, the story about Hillary's emails on this station went on forever. And now on different stations, the story about the impeachment is going on forever.
Yeah.
It's just, let's focus on things that that will have a material impact on our life.
Well, we got 38 days, I think, till the Iowa primary, or the Iowa caucuses, I guess they are. So that'll get us.
Okay, now my emotions just got triggered
I know,
there.
yeah. So we'll get so excited about who comes out there, and then New Hampshire's next a couple of weeks later. And
so we need to have an expert on with tips to set up new filters for your inbox and your notification settings to combat what's about to happen.
Yeah, everything will start happening here on our announcements for promotional political
ad rates are going to be going up here.
Ad rates are going to be going up.
If you want to advertise on this wonderful show,
that's right.
Contact one of the great salespeople.
Yeah,
there's good spots still available.
There are, absolutely right. Yeah, we've got plenty of room.
Last minute tax saving tips. I'm sorry, I got to jump in on this one.
Go for it. Yeah.
The rule number one is that buying a car will not make you money. I will restate that. Buying a car will not make you money. If you plan on buying a car for legitimate reasons, you may benefit from buying a car now. Car salespeople, and they support this show, but I don't think that they would be alarmed to hear me say this, is that they're waiting for people that need to buy a car to come in right now. So
that's for sure.
My wife and I are, in fact, looking for a car, and I think we'll probably just wait till next month maybe to see if we can't not deal with this price versus value conundrum that Shane did a great job of explaining earlier. Now, there's a lot of deferral opportunities, too. So the key here is that you might have made X. You can still start a company retirement plan of a variety of flavors all the way up until your tax filing deadline in April, and potentially even October if you extend. I don't want you to plan on that, but you can. So you can wait to do some tax mitigation work for what I hope was a great year for you this year. I hope that everybody out there participated in the boom. And the taxable income that you may be looking at, I've got some realtor clients. Yeah, they're looking at strong years. They're looking at significant tax bills. They're looking at strategies saying, okay, if I was going to replace my car in the next few years, it might make sense to do it now. You can get a great write-off on big cars and all those sorts of things that they talk about. Mm-hmm. But we're also talking about what retirement plans can we set up. The solo 401k is usually my favorite for the independent or quasi-independent business owner. You can put away up to $56,000 a year if you design these things right. That means that if you have a taxable income, and I'm sorry for the people that didn't, I'm not one of them, that is excessively high, you can slice that much off your taxable income. And at that high tax rate, that's almost a 50 cents on the dollar savings, or at least delay in savings. So there's a lot that can be done with regard to that. I always caution people, go slowly into any sort of long-term contractual sort of agreement. Mm-hmm. Now's not the time to be looking at annuities, those sorts of strategies. Take your time. It won't save you any money putting money into those on a tax basis. So be very diligent about that. And yes, there's still things you can do if you're part of a company 401k. You got to be friends with the payroll person to be able to put your last paycheck all towards your 401k. Mm-hmm. That might be one of the smartest things you can do. So contact your HR and see if that's a possibility.
All right. All right. Thanks, Mike. Always a pleasure.
It's always a pleasure to be here. Let's just be thankful for a year like this. May we be here in 1 year sitting on a year like this, or even half as good, right? Let's be modest.
All right.
Well, Happy New Year, Mike, and you and your family, and enjoy that New Year's Eve drink.
Yeah, once a year.
That's
on
it.
New Year's.
That's it.
I'm going to go wild.
Hey, I got some basketball tickets to give away. I got 2 tickets for Sacramento State. That's going to be Saturday at 4 o'clock. Give me a call. 522-TALK is the number, 522-8255. If you want to attend that game, you can win 2 tickets. So give us a call, and we'll get you set up for 2 tickets to Saturday's game, 4 o'clock, December 28th.